Hello, everyone, and welcome to our session on revenue and accounts receivable. So as we all know, revenue is the top line, the money coming in our organization or our business, basically what keeps our business going and what allows us to conduct programs, to incur some expenses and costs, and to deliver services. So what types of revenue do we normally see in indigenous organizations? So first and foremost is the government funding. We have funding from Indigenous Services Canada, Health Canada, CMHC, and so on. Then we can also have own source revenue. So this is more related to economic development initiatives that First Nations and related organizations undertake. So we can have a gaming operation. We may have a smoke shop, gas and grocery store with sales. We can also provide internet and phone services for community members, and so on and so forth. In many cases, First Nations own businesses such as home hardware stores or like in this example, gas stations. Those businesses would generate revenue from just regular sales as any other business. Another type of revenue we may have is trust distributions. Many of the First Nations in Canada have certain government settlements held in trusts. Those trusts make investments and they're governed by trust agreements. So the money from the trust can only be used for certain purposes. And then every year, a trust makes a distribution to the First Nation or related organization, and that becomes the revenue in the First Nation. Then we can also have other income. So that would be something that doesn't necessarily come in on a regular basis. So we can have legal settlements, right? So maybe we do have a lawsuit over our land against the government, and we can receive some money that way. We can have interest and investment income. So we have some money invested somewhere, then that would generate revenue from investments every year. And then we can also sell assets. So we own buildings, land, and so on. That doesn't happen very often, but sometimes when we do sell assets, we receive proceeds on sales, money is coming in, and then becomes our revenue. Okay, so let's talk about revenue accounts. So when I say accounts, I refer to categories in our accounts and records. So there could be different categories for revenue that we use for recording and reporting. So revenue accounts are always at the top of our income statement or profit and loss, except for other income. So those legal settlement proceeds, maybe gain on sale of assets, maybe some investment income, that is many times presented at the bottom of our income statement just because it's not recurrent. It doesn't happen all the time. But in general, revenue, all the money coming in, is going to be the first thing we see on our income statement or profit and loss. Now, our revenue categories or accounts can be set up by funder or by revenue type. It all depends on the requirements that we have from our funders, from funding agreements, and also it all depends on our needs as users. So if management would like to see, say, a store income statement in a certain way, if they'd like to track gas revenue separately from groceries revenue, then in accounting, we normally want to set it up so that it's useful for the management. So we consider the needs of the users of the income statement, either funders, the management, chief and council, community members, whoever are the ultimate people we work for. So like I said, it's best to set up accounts based on funder and audit requirements, and it's important to consider what makes most sense for the user. Now, when I say audit requirements, normally the auditors would try to satisfy the users as well, so they would go along with what the funders want. So if we just work with the funders, chief and council, community members, and all important users, the auditors will most likely be happy with that. So let's review some sample income statements for where and how revenue is presented. So the first example I have here is the famous Apple Inc. So the company that produces all our iPads, iPhones, and Apple Watches, and all the rest of the wonderful electronics we like to use. And you'll see here revenues presented under net sales. And for them, what makes sense is to separate it to products and services, right? So for their users, for Apple users, this is what makes sense the most. And so products would be like iPads, iPhones, and so on. And services would be all the apps, for example, right, that we can use. So it's just one example of how an income statement can be presented, revenue can be presented based on the needs of the users. Let's look at the next example, which is an audit for a First Nation. So here you'll see the revenue is presented by funder, right? So because First Nation audit is very important for keeping our funds in place, then we have to meet the requirements from the funders, and they would like to see revenue by funders. So that's how we present it. So we have Indigenous Services Canada, we have FNIB, CMHC, and so on and so forth. Okay, so now I'll stop sharing this and I'll share some internal financial statements for First Nation businesses. So here you see a gas and grocery store operated by a First Nation. And in this case, they would like to report separately grocery, tobacco, gas, and retail revenue. So here you see this is separate. So why does this make sense? Well, really, when you operate in a store, you first of all want to see what you sell the most of, right? So then if you keep track separately of your gas and groceries and tobacco, then you can see the trend there. What do people buy the most? You can also compare to previous years, right? And see if there is an increase or decrease in, say, your grocery sales or gas sales, right? And then what's probably really important is you can calculate your profit specifically for a certain product, right? So you'll see in this case, we keep track of grocery sales and of grocery purchases separately. So we can calculate how profitable every product line in the business is by keeping those categories separate. So bottom line of this all, always consider the users. So if you have in your organization a chart of account with revenues listed, categorized in a certain way, and maybe it's old and is no longer useful, you may want to consider changing that. Okay, it's normally it doesn't take significant effort to change that. You'll just have to get everybody involved to agree to it. And the same stands for expenses. This webinar deals with revenue, but really even in expenses, we always want to do what makes most sense to the user, okay, to the ultimate users. ISC funders are important, but our management, like economic development people, chief and council, and community members, if they review statements, they're probably even more important. Okay, here's another example. So this First Nation operates a community complex where they have their gaming operation, a restaurant, they rent a hall, they have some ATMs there, and a smoke shop. So in this particular case, because it's one income statement, one profit and loss for the entire center there, economic development center, they present the revenue here by basically an operation within that economic development center. So VLT revenue, restaurant revenue, hall, and so on. So this is just to give examples how it's fluid, the presentation of our revenue and classification. And the most important thing, that it meets the needs of whoever is reading those financial statements, okay? We don't want to have financial reporting for the sake of financial reporting. We want it to be useful. Okay, so let's go back to our presentation. So let's talk about how revenue is recorded. So in general, we have kind of two types of transactions. And for simplicity, I call them a one-step transaction and a two-step transaction. So one-step transaction is when actual revenue and cash flowing happen at the same time. So for instance, when we receive a funds and deposit from the government, the way we see the revenue, we just look at our bank statement, we see a deposit coming in, right? So it just happened all at once. Another example is, say we sell gas at a community gas station and somebody pays with a debit or a credit card. So that sale and collecting a payment for that sale happens at the same time, right? So technically it's just one step that happened there. So in that case, what we can do is just use what's called a sales receipt. So a sales receipt in our accounting system would record that revenue, that sale, and then, you know, put the cash into our bank account. Okay. Now, many times we sell on account, right? Or sometimes we're eligible to receive revenue, to receive funds in, but for whatever reason, the government is slow and it doesn't come until 2 or 3 months later, right? So now what happens in our system in the meanwhile, we're spending money on that program, for instance, in my government example. And so we're showing a loss for that program because we spent the costs, but we haven't really received the funding yet, right? And so in this case, what we do is what's called a two-step transaction. Okay, so in this case, we record the revenue when we're eligible to receive it. And then collection of the revenue, so a payment of the funding from the government may happen later, but the revenue itself is recorded when we're eligible to get it. So then in our income statement, we don't show just costs and no related revenue, okay? So it's the same example with selling on account. So if my grocery store at the community, say they sell gas to the school for $10,000 and the school isn't going to pay for it until a month later, what I'm going to do is as soon as the sale happened, the school got the gas and I'm eligible to record the revenue, I will record the revenue. So it will go into my revenue account with an offset to a holding account, to accounts receivable. So for some of you, you know accounts receivable really well. If you're new to it, just think of it as this is a holding account for amounts owing to us, right? So in my example of a gas sale for a school, then when the sale happens, when the school gets the gas, I'm going to record revenue in my system of $10,000, and there will be an amount owing from the school of $10,000 or accounts receivable. Now, when the school pays for that gas, say a month later, then my revenue won't be affected because I recorded it right when the sale happened. Instead, I'm going to record a cash coming in and then reduce that amount owing, that account receivable that I recorded when recording the revenue originally. So why is that important again? Well, we use accrual basis of accounting for all our bookkeeping, for our audits and everything else. And one of the main principles of accrual basis is matching revenue and expenses. So if my expenses happened in a certain period, I have to record the related revenue that relates to those expenses in that same period. For many of you working for First Nation organizations, you've probably been a part of a project where it got approved in January, and then you only have until the end of March to spend on that project. And then you start spending, vigorously, because if you don't spend until the end of March, it's not clear whether they're gonna let you carry it over to next year or not, right? So, but at the same time, the government approved it in January, but they really aren't flowing the money until after March, until April. So now what happens? Now I have a lot of expenses for that program and really no revenue recorded, right? Because it hasn't come in until April. So what we do under the accrual basis here is we create an invoice and set up a receivable from the government, right when we're eligible to get the revenue. So then I have revenue to offset my expenses, and I'm not showing a loss for that program. Okay, so all this long blurb was about a two-step transaction, in which case we create a customer invoice. So a customer invoice is used when there is a time lag between making the sale or being eligible for funding and receiving the actual payment. Okay. Sometimes you have to use what's called journal entries. So those are hardcore accounting transactions where you need to know the technical debits and credits in accounting well to do that. With journal entries, we have to keep in mind that our auditors have to review 100% of all journal entries. So that means anytime we use a journal entry, we create more work for the auditors and our audit fee goes up. Okay, so if we can stay away from using journal entries, we should. The reason for auditors reviewing 100% of your journal entries is because if somebody were ever to try and cook the records, this is the way to do it, is through journal entries. It's never through creating an invoice or sales receipt, because that normally is tied directly into cash or specific customer account, okay? So auditors look at your journal entries with a magnifying glass, keep that in mind. Now, saying all that, some accounting software has been around for a very long time. And unfortunately, when they started, developed the accounting software, the way to do things was mainly through journal entries. And so it could be that you're working with accounting software like Sage 300, for example, where everything kind of has to be done through journal entries. That's okay. Like, we just learn what we have within our organization, we adjust to it, and then our auditors adjust accordingly, okay? But if you're working with a newer accounting software like QuickBooks, maybe Sage 50, then definitely take advantage of using customer invoices and sales receipts as opposed to journal entries. Okay, accounts receivable. So like we said, it's just a holding account for amounts owed to us by customers and funders. It is an asset on the balance sheet. It's normally right at the top of the balance sheet, right after cash, because it's considered current. It should be converted into cash. Somebody should make a payment to us, hopefully within a short period of time. So accrual basis of accounting, which is used for all our bookkeeping and the audits, and this is what's recognized by all the funders, requires maintaining accounts receivable. For that reason, like I said before, because revenue belonging to a certain period should be recorded in that certain period, regardless of when we actually received the cash, actually got the payment. Okay. So what does it mean on a day-to-day basis for us? Do we set up accounts receivable? Say if we just receive funding from the government, right? Do we set up accounts receivable on a monthly basis for whatever didn't flow? Say maybe we had some halts, maybe there's some delays and whatnot. Well, practically, most of us don't do that. So we normally do it when we prepare, say, quarterly financial statements. And for sure, we do it when we prepare for the annual audit. So if at the time of the audit on March 31st, there is some funding that belongs to March 31st that hasn't been received yet, we have to set up a receivable in our system. Otherwise, our records are incomplete. Okay. So another thing to mention here, how we maintain accounts receivable is through reviewing what's called an aged accounts receivable report. So what it is, it's just a list of all the amounts owing to us from different customers and funders, and it's broken down by the agent, like how old that amount is. Normally there's 30 days, 60 days, 90 days, 120 plus, right? So it is very important we review the report on a regular basis, in particular if we're in some sort of business operations, right, where we collect from customers and sell an account all the time. So it is important so we can see who owes us money, right, and so we can collect. Because when we record an invoice and set up a receivable, now we have that sale and we have the profit. But until money is collected, this is all just in accounting records, right? So we need to convert the receivable into cash. Like customers need to pay their bills to us, right? And so if you work with accounts receivable, if you work in a commercial operation, or even within a First Nation, maybe like a store or internet provides an operation or phone, definitely make it a habit to review your accounts receivable aged summary at least on a monthly basis and check who owes you money, who owes the business money. And then the next step is to do collections. So either yourself or somebody that works with you makes the phone calls, right, and tries to collect from the ones that have been outstanding for say longer than 30 days. So let's look at an example of aged accounts receivable report. So you'll see here, just like I said, you have a list of customers, you have total amounts they owe, and then you have a breakdown to agent, to when the actual invoices were issued, right? So if I were to review this list, I'll be asking questions about, for sure, anything over 91 days, right? Why is it still outstanding? Why didn't customers pay their bills for over 3 months, right? And I know that for most of us, when we're busy with operations, reviewing something like this is not necessarily always a priority. Well, it's really important because, like I said, if we're recording sales but no receiving payments, then really all the sales mean nothing. They're just on paper. Okay, so let's just quickly walk through how accounting works for accounts receivable. So when we record an invoice, the two-step transaction, at the time of invoicing, we will have accounts receivable of $1,000. In my case, that's $1,000 sale, and revenue or sales of $1,000. So now when the customer pays, I will have money coming into the bank of $1,000 and a reduction of $1,000 to accounts receivable. So you will see that in the end, all that remains in our system is a revenue of $1,000 and cash in the bank of $1,000. Okay, and accounts receivable will be at zero once payment is received. Now for a sales receipt, which can be called something different in your accounting software, but the gist of it, it's a one-step transaction. We don't use AR at all. All we do is we record revenue and bank, right? Money goes into the bank of $1,000 goes into the bank and gets recorded into revenue. So a good example for something like this is your government deposits that come on a monthly basis. The funds and deposits, we don't have to put it through accounts receivable unless we're working with one of those more complicated or older systems that require it. Okay, there is journal entries on the side here for the ones of you that are familiar with it. If you're not, then don't worry about it. We'll have a different session on journal entries. So now when we review our accounts receivable agent report, remember the one with all the customers and amounts they owe, and say we have to adjust something. So we see that it shows that customer A owes some money, but really we know that they don't anymore. Either we can't collect this, or maybe it was already collected and just recorded as a sales receipt instead of being applied to accounts receivable to reduce that account, right? Well, we have to be really careful with adjusting the accounts. The best way to adjust is through creating a credit, a customer credit to the individual customer's account. So if we do it in other ways, sometimes it won't post it into the individual customer account, and we can create a bit of a mess in our system. If you've never had to deal with it, just keep in mind that adjusting existing accounts receivable may need just help from somebody who's done it before, just to make sure that the individual customer account gets cleared, gets to where we want it to be. Okay, and we said review aged accounts receivable for maybe old accounts to collect them, and maybe for some uncollectible amounts, right? Especially when we're getting ready for a year end for our audit. If we have some old accounts receivable sitting on the list that we don't think we're going to collect, we shouldn't keep them on the list. We should write them off. Okay, so writing off accounts receivable. Say something is uncollectible. There is two ways. So one way is when we know for sure it's never going to be collected and we just want it out of our system. This is when it's just written off, that account is zeroed out. And then another way is when it's uncollectible, but it's kind of doubtful. So there is still a bit of a chance that we may collect it in the future, or maybe we sent it to collections, maybe we're involving lawyers to try and collect something, right? So in this case, we don't really want that individual account out of our system. We still want it in our system because we want to support, yeah, they owe us money. But for ourselves, we know, well, maybe they owe $10,000, but this case scenario will collect $3,000, okay? So we know that out of that 10,000 that sits in there, 7,000 is uncollectible. So in that case, what we use to keep the account at $10,000, but still make sure that we record the portion we think is uncollectible, we use what's called an allowance for doubtful accounts. So there's just another category right under accounts receivable that would show amounts in minus that reduce accounts receivable overall. Okay, so just to I didn't mean to confuse anyone here. Just keep in mind there is two ways to deal with accounts receivable that are not collectible or that are doubtful. If we know they're gone, we're never going to collect them, we write them off through customer credits. If we think we're going to collect them, we don't write them off through customer credit. We keep them in there and we use that separate account under accounts receivable that's called allowance for doubtful accounts to record a credit in the amount where they think is uncollectible. The whole reason is we want amounts that may still be collected still shown in our system. We don't want them out of our system if there is still a chance that we'll collect. Okay, so here's an example. I have accounts receivable of $100,000 and $100,000 of revenue, and $8,000 is uncollectible. So after my adjustments, my accounts receivables will sit at $92,000 because I just took out the 8,000, right? And then my revenue will remain at $100,000 because that was the amount I originally earned, but I'll also have a bad debt expense of 8,000, right? Because it was a bad debt of 8,000 in that case. Now, what if 8,000 is doubtful? So 50-50, I'm not sure if I'm going to collect it, and I'd like to keep it in my system just to support that it's owed to me. What I'm gonna have is my accounts receivable will remain at $100,000. So that account will remain in there. And then right under accounts receivable, I'll have this allowance for doubtful accounts. So when you see this from your auditors, now you know what it is. So that would be $8,000. And then my net accounts receivable will be $92,000, right? So just like accounts receivable were $92,000 in the completely uncollectible case, it's going to be a similar number here, except this will allow me to keep the actual account still in receivables while showing it as doubtful through this allowance. Okay, and revenue and bad debt expense would be exactly the same in both cases. Okay, so let's talk about government funding because it happens to be the majority of our revenue for First Nations and related organizations. So governments have really big legal departments, right? Because everything has to be in accordance with the law. And so all their funding is governed by contribution agreements. So normally you won't get a penny from the government unless there is a signed contribution agreement. So that contribution agreement can be a long legal document and it sets the terms, including the conditions, the timing of funding, and reports and requirements. Now, saying that it's a long legal document, but it's a pretty standard form. They all look the same. Like for the ones of you that work within First Nation have seen them, you'll see that they all look pretty much exactly the same because it's not like the government lawyers make up something completely new every time. And so what becomes important is really there are a few sections of those contribution agreements. In particular, there is a budget in the end of the contribution agreement showing you all the funding that is coming your way, that the First Nation, your organization is eligible for. And what I always say, even though we like to leave the legal work to the lawyers, but it's really important to try and review and understand those contribution agreements, in particular the financial section, the budget where it shows all the money coming in, all the eligibility, right? And this can be obtained from your funds and services officer, right? Say ISC. And if you have questions about an agreement, they're more than happy to answer your questions. But it's like that agreement governs everything. So if we don't know the law, if we don't know the basic document that governs our revenue, then we're at a disadvantage. So it's really important to get a copy of our contribution agreement and at least try to review the sections we understand. Okay, which would be the financial sections because they're just numbers. So some funding is ongoing with automatic monthly or quarterly bank deposits. And so in that case, speaking of revenue, we wouldn't be issuing an invoice and having accounts receivable for that funding unless that's what our system requires. So in that case, we can just use a cash receipt to record a bank deposit when money comes in. Sometimes there is project-based funding. So we have to submit a special application with a budget and with funding request. So that's not going to be there every month. It's going to be based on meeting certain milestones. And this is with project-based funding. This is when you can see delays sometimes. This is when, they get your they approve everything and everything looks good, but there's just no money coming from the headquarters until 2 months from now. So you're trying to spend to meet the deadline, but you're not gonna receive the actual funding until 2 months from now, right? So in that case, if you are in that situation and there is an important reporting date in there, say like a year end or maybe a quarter end, you may want to create an invoice and accounts receivable for that funding. Just because otherwise, for that specific project, you will show a bunch of costs and a loss and no revenue coming in, right? So period end verification procedure. This is one of the basic procedures your auditors do. They pretty much start with it, is agreeing the revenue, funds and revenue recorded in our system to fund and confirmation report from the funders, okay? So I strongly suggest we make it an ongoing procedure for ourselves because that just makes sure our records are accurate. Right now, the government send out funding reports every month. You have all the funds and deposits listed on the reports, and by Indigenous Services Canada, you can request and receive similar reports from other funders as well. Health Canada is included with Indigenous Services Canada, at least in EBIS. They're on the same report. CMHC, you normally don't really need those reports, but if you do, you can ask them for those reports because their deposits are pretty consistent unless there is a one-off project. So in any case, it's a good procedure to have when you prepare your quarterly reports, and for sure when you prepare for the annual audit, is to agree funds and recorded to the confirmation received from the funder. Okay. So another thing I wanted to speak about is funds and types. And this is particularly related to Indigenous Services Canada because they happen to be probably the biggest funder for most of us. So their funding is divided into different contribution types. First one is set contribution, okay? And this one is the most restrictive. If you have any surplus at the end of the period, it has to be paid back, okay? Then there is fixed contribution or flexible contribution. So this is where we can carry over any unspent surplus. So if we have surplus at the end of the period, we can carry it over, but it can only be spent on the same program, okay? So now, if we have a flexible contribution with a term, so say it's flexible, it can be carried over, but it's a 5-year term. A good example is Jordan's Principal Program for First Nations. So in this case, we can carry over surplus in the program only for the duration of the term. So if we're in the last year of the 5-year term and we think we're going to have a surplus in the end, that surplus has to be repaid. So it's important to understand when working with different programs for government funding, what are the repayment terms? And again, reviewing the contribution agreements and understanding the terms of every funding stream becomes very important for that, just so we don't have any clawbacks and repayments in the end. Now, for many of our First Nations, they're in a 10-year grant funding, which is probably the most flexible funding program. where everything can be, carried over, and it's not as restrictive as when you have different contribution types. So in this case, those First Nations are definitely in a better position, except things to keep in mind. If you want to enter a 10-year grant funding, if you're not in there yet, but you'd like to consider it, keep in mind that all you carrying over surpluses, like all the surpluses you're carrying over right now, would have to be repaid before entering the 10-year grant funding. And then also at the end, because 10-year grant now has a term, right? At the end of the 10 years, you will have to do the surpluses as well in a creative way, because now there is a term in there. Okay, I'm just going to show an example of funds and confirmation from IFC. So you'll see here, let me just see if I can make it a bit bigger. There. So you'll see here that they divided by contribution type. So in my case here, there is nothing for set contribution. So in this particular case, no set contribution funding, which is nice. So nothing has to be strictly repaid at the end of the year. Then there is a list of fixed contribution funding. So remember, for this one, we can carry over, but it has to be spent on the same programs, right? There is also a bit of a complication in there. If we carry over fixed contribution funding, the carryover works for as long as the total amount we're carrying over does not exceed the amount of my annual funding. So for instance, if annually I get $1 million, I can carry over to the future up to $1 million. If in a certain year I have to carry over $1 million and say 100,000, then that 100,000 that's in excess of my annual funding will have to be repaid. So the carryover provision here is really generous, but you have to keep in mind this whole carryover business is it needs to be really studied and managed. The best thing is to carry over as little as possible, but we'll definitely discuss it in our future presentations. Okay, then you see some flexible contribution here. So in this case, that contribution is under a term. So even though it can be carried over no problem while you're within the term, once your 5-year term is over, any remaining surplus has to be paid back. Okay, then there is grant contribution, which is kind of great. It's normally just your band support. But they really don't care how you spend that money. So that's pretty flexible. And then I do have some set contribution here. You'll see medical transportation. Not too fast here. So in this case, medical transportation is a set contribution. So if I didn't spend some of this funding during the year, I'll have to pay it back. Okay, so that's all I had for revenue and accounts receivable. And now's the time for your questions.